Hello and welcome to the Real Vision Daily Briefing. It's Friday, February 25th, 2022. I'm Maggie Lake. The two stories dominating the markets this week: the Russian invasion of Ukraine and the upcoming Federal Reserve meeting. To help us understand both, I'm joined by Dee Smith, founder and CEO of the Strategic Insight Group, and Joseph Wang, former senior trader at the Federal Reserve. Welcome to both of you. And Dee, I'd like to start with you first. We saw a big bounce in European and U.S. equities today. U.S. stocks just closing, rallying into the close at their highs of the day. The Dow up 834 points around as we settle 2.5%. We have the S&P up more than 2%, the Nasdaq 1.5%, oil backing down to $92 on WTI, $98 on Brent, gold also slightly lower. Part of the catalyst headlines that Russians say they are willing to hold negotiations with Ukraine. Is this just a tactical maneuver, or do you think that Putin is looking for a diplomatic solution?
It's a complex situation, and what has happened is that the advance of the Russian troops, and it's a multi-pronged attack on eastern Ukraine. They're not attempting to attack the west at this point, but they're being slowed down by Ukrainian resistance much more than they thought they would be. They're having trouble taking Kiev. They didn't think they would. They're still, really mostly stuck in the northern suburbs and other suburbs, but they're not effectively in the city center. There's a lot of resistance around the country. And I think that they are feeling a pinch of that. And that's having two effects. One is that it is actually causing them to speed up their timeline in an attempt to do this more quickly. But it is also giving them some pause. And, the received wisdom on this kind of a situation is that it's relatively easy, and easy in quotes there, but relatively easy to take down a country as the military system. It's much more difficult to control it. So if they're already having problems taking it, I think it is giving them pause, and I think that there is some evidence that there's some dissension in the leadership and concern about what Putin's doing. There certainly have been demonstrations, which is a very dangerous thing for people in Russia to do now. So I think there is just some pause in thinking. That doesn't mean there's any pause in action, but
Yep.
they're not being able to proceed as quickly and as effectively as they thought they would. Now, having
Yeah.
said that, there's no way that the Ukrainians can stop a full throttle Russian invasion, but they can make it very difficult.
Yeah, and they appear to be doing that, as you say, perhaps something that Putin didn't calculate. And there are so many moving parts to this, aren't there, Dee? Breaking in just the last 15 minutes, reports that the U.S. will impose sanctions on Putin himself, may be symbolic, but that is coming following in the footsteps of the EU. Russia is threatening Finland over NATO. We have China not coming out and condemning Russia, but reports that some of the state banks have restricted dollar financing in Russian commodities. A lot of uncertainty what's happening with the Black Sea and flow of goods there after some ships were damaged. I mean, there is a lot going on. What should we be focused on as we head into the weekend? What are you going to be watching for as critical?
Um, there's several things. I think that we need to look at the constraining factors on Putin, which are there. There's several of those. The resistance is one. The morale is another one that I think is related to the resistance and related to what I spoke about earlier. There's uh, essentially a how would you put it? A kind of dissolution of parts of the circle around Putin, perhaps. So he may be fighting some battles of his own. I think one of the things that is really concerning is that he has apparently, and I've talked to people who've talked to him in the past and recently, he is not the same person. He's been in isolation. He is not thinking perhaps very clearly. Apparently, every time anyone sits down with him, it's just a long diatribe of what's wrong with Ukraine and Russia and so forth. And he has also created some effects that he did not intend. I mean, what he wanted to do, and this I'll have to attribute it. It's not for attribution remark. In a call I was on with a U.S. general yesterday, but he wanted to make Russia great again, and what he's ended up doing is making NATO great again.
Mm.
And so that's this is not working out the way he wanted it to, and so that there are these limiting factors, and I'm going to be watching how those play out. I'm going to be watching how quickly he can consolidate territory, which is not as fast as he thought it would be. I think the markets are being irrational to an extent. Every bit of bad news and they collapse, and every bit of good news and they rally. And the situation, unless it begins to really work itself out very quickly, and which would mean that he stops where he is and does begin peace talks, you're dealing with a situation where you're going to have huge market effects of
Mm.
this. Russian oil and gas out of the picture. The projections now are that Europe's primary energy bill is going to be about 1.2 trillion this year. That's about 200 billion more than it was forecast last month. You've got some mitigating issues there. Saudi production increases, maybe a deal with Iran. It might put a couple of million barrels a day back in the market. But, you've got food issues. I mean, together, Ukraine and Russia account for about 24% of global wheat production. Wheat's up more than 5% this week, on top of an 80% increase from April to December. Sunflower oil, all these critical minerals, uranium, clay exports, titanium. You take those things out of the market because of a conflict based situation, and you're going to have massive in an already inflationary environment, I might add, and an environment that's already plagued with supply chain problems. You're going to have massive effects on the commodities market.
Yeah, absolutely. You make such an interesting point about him coming out of isolation, maybe out of touch with what's been going on. That is not something we've heard. I'm sure that, it important not to underestimate him though at this point, right? What is your sense on what his grip of power is within Russia? Is this a weakened Putin that we're dealing with, or is it just that he may have misread the situation but still has plenty of cards to play? I mean, we know what happens when people protest. He's had an ironclad lock on that country for so long. Do you think it's changing?
Not at the moment. I don't know if you watched that conference that he had with his advisors, with them all sitting in a semicircle, and he was over at the other side of the room. It was Orwellian. It was surreal. He was criticizing them, and he's. I don't think he's lost his grip on power. He may have lost some of his grip on reality, and I think that's very concerning because and I use this phrase in the way I mean, but a mad king with nuclear weapons is not a good thing. And the other issue is that he really only understands power, and if the West wants to stop him, and we're starting to do this, but you're going to have to ratchet up these sanctions, and they bite over weeks and months, and the Ukrainians just have days and
What about
hours.
what about Swift? Does that put Swift back on the table, especially if there's a
I
sense
think Swift has always
that
been on the table. The Germans, in particular, and some other European countries don't want to see that happen because they're still dependent on various things, including energy from Russia. And what Swift is, I don't know if everybody knows.
yeah,
It's essentially a
it's worth
messaging system.
explaining. Yeah, it's the
It
it's the
is a
it's the
system
critical
that
system, right? That sends secure payments between banks. It's the lifeblood of
it doesn't.
all sort of trade
Yeah,
and flow.
yeah, it doesn't send payments. It sends messages about
Right.
payments in a secure and a trusted way. And so there would be ways to work around it, it's a highly symbolic move, almost a talismanic move. And the Germans in particular have not wanted to deploy it. But it may, if we're going to really stop him, uh, it's going to require some, painful things that are going to be painful for the West. And here's the dilemma: is that the danger to financial markets if we do those things becomes greater.
Mm.
If we don't do them, if we go a road of appeasement, then there's very little danger to financial markets in the short run. I'm leaving out the possibility that this becomes a cyber war with an untold amount of damage, but leaving that to the side. It's not happening in any obvious way right now. Um, and that's that's a doomsday kind of scenario because both sides can do it, and it's much easier to be offensive than defensive. But so the extent to which we don't uh, let him get away with this, it's going to hurt the markets. It's my analysis. To the extent that we appease, that we don't we just slap his hand, the markets will have very little effect. So you've got this odd dichotomy there.
Yeah. One headline that caught my attention, Meta, Facebook, was partially banned in Russia for fact checking content from state owned media. Uh, is there a risk that Putin can't control the narrative? And there's also risk for countries like Germany and those who are sort of maybe holding back. There is the real possibility that we may all sit and witness mass Ukrainian casualties, a refugee humanitarian crisis playing out. And that is going to get out whether authorities like it or not, whether Russia bans Facebook from Russia or not. I mean, with social media, we already are seeing, these images of civilians, walking with suitcases. I mean, it's eerie. It's like going back in time. There's risk for both sides on this, but how important is controlling that narrative, and who's more vulnerable? What would it mean for Putin, especially if, as you say, he doesn't completely have cohesion around this decision?
It's very important to him to be able to do that, and it's another limiting factor that he, there are ways around that. He does not have the kind of control over the internet that China does, for example.
Mhm.
And of course he has very little control over Ukraine, other than to shut power off, which he would have to use a cyber attack to do. And so, just as a sidebar, one of the fascinating things about this is these TikTok videos and others that of things going on, and you can tell from the metadata actually that they are where they say they are. Now, having said that, there's a lot of fake videos of old videos and things that have been put in. So there's a lot of work going on to try to filter through those. But he is going to have trouble controlling the narrative, particularly when Russian soldiers come home in body bags, and that is going to have the kind of impact on even the Soviet Union in the days of Afghanistan and before anybody ever heard of the internet. um, couldn't control that narrative and ended up having to have, it was essentially the same kind of experience we had in Afghanistan.
Yeah.
So I think it's a short term thing will work for him, but as it drags on and gets more onerous, he's going to be more motivated to call some kind of a halt to it. Or the other danger is he may, before that, be more motivated to become more brutal, and it could get really nasty. And the kinds of things that were done in Chechnya and so forth. And I hope that doesn't happen, but it is certainly within the realm of possibility, and it's really concerning. And we
It,
will see pictures of that.
it is so concerning. Extraordinary times that we are in right now. Dee, we so appreciate you coming on and sharing your insight. Please come back again soon.
Look forward to it. Thank you very
Thank you
much.
so much. Now, the other big story, of course, is the Federal Reserve, and they're intertwined right now because markets are trying to grapple with both of these forces. Before this week, the Fed was the main story, and we did have data out today, partially overshadowed by developments in Ukraine, which showed the PCE, one of the Fed's favorite inflation gauges, was the highest since the early 80s. Consumer spending and durable goods orders were also stronger than expected. Let's bring in Joseph into the conversation, who's been patiently listening. And Joseph, there's so much for investors, for market participants to grapple with, given everything we've seen on the geopolitical and data front. What are you expecting from the Fed next week?
Oh, hey, Maggie. First of all, thanks for inviting me here. I really love Real Vision, and thanks, Steve, for a great discussion. That was super interesting. Before this whole Ukraine thing happening, what the market was thinking about was what would the Fed do? And I think to understand what the Fed would do in the next meeting is to look at the world from the Fed's perspective. What does the Fed care about? Again, full employment and price stability. Now, where are we on those? full employment has been met. We see employment conversation at multi-year highs. You've had Fed governors come out and tell you that we've met full employment. And so, what about inflation? Well, inflation is far, far above the 2% where the Fed would like it, like you mentioned. So, from this lens, you can kind of interpret what Ukraine and this Russia saga will impact the Fed. As Dean mentioned, there's a potential here for significant surges in commodity prices. So, the Ukraine incident, that is a potential upside risk for inflation, something reminiscent of what we saw in the negative supply shock in oil back in the 70s. So, in my view, this the thing keeps the Fed on track. I mean, there's no way the Fed is going to, let's say, look at this and become more easy. They're going on track to going to hike probably once every meeting. The more recent take we have from this is from a speech by Governor Waller a couple of days ago, and he was still open to 50 basis points. Now, that's probably not 50 basis points in March. Now, that's probably not the most likely outcome. But if we get a big CPI print in, say, March 10, when the next one comes out, that's on the table. So, right now, what's happening in Ukraine hasn't changed the Fed's calculus, in my
Yeah.
view.
Yeah, if anything, perhaps put more pressure on them as they try to grapple with inflation. I mean, do you think we always talk about the Fed having blunt instruments to try to deal with this? Do you think that they are going to be successful in trying to fight inflation? How much of this is an expectation game and how much do we have to wait? Because there is a lag between what they do and any effect on the economy. How are you thinking about all of that? And will that determine the pace of tightening? Do they need to be more aggressive to sort of show they're getting in front of it?
Yeah, that's a really interesting question. So the Fed raises overnight rates and tightens, and how does that actually feed into the real economy? I don't really think there's a consensus on this.
Mm,
I think most economists have the view that you've just enunciated monetary policy acts with a longer variable lag. So if we hike now, maybe sometime in the future things will slow down. But when Chair Powell was asked about this, he's like, "Yeah, I don't think that's how it works. In fact, when I hike rates, that's immediately priced into the markets." And he's right.
mm.
So the Fed, by communicating that the Fed is going to hike maybe multiple times this year, you can already see that priced into the short-term interest rate markets, priced in the two-year Treasury, and priced into the belly. So I think the impact is immediate. But here's the thing, though. It seems like, in my view, the impact of the Fed is much stronger on the financial markets than the real economy.
Mm.
I'm not sure if an extra, let's say, 200 basis points is going to affect on consumer spending or business investment. It doesn't seem like it would make a difference, especially when, let's say, in an inflation environment where businesses are having record profits and employees are having record wage gains. So I think the primary impact would be on the market, and it can be a substantial impact. So
Yeah.
the way that I look about this is that the primary mechanism from how the Fed impacts markets is its impact on the debt market. The Fed, by raising rates, very direct impact on, let's say, short-term to medium-dated treasuries, and then they're promising to do very aggressive QE to make sure the long end goes up as well. And when you're doing that, though, mechanically what happens is you're haircutting everyone's bond portfolios. And if you do that just through rebalancing mechanisms, let's say you're a target date fund, maybe you're just a classical investor with a 60/40 portfolio, maybe let's say risk parity strategy hedge fund, you're going to have to sell equities to rebalance. So I think that impact is probably the most direct impact, and you see that kind of playing out a little bit heading into this year, and I think we're not done yet.
So this is so important. So you're talking about what we refer to as quantitative tightening, correct?
Right.
The reducing your balance sheet. And we mentioned at the beginning of the program that you are a former Fed trader. You were on the open markets desk, the open markets desk during, if I'm not mistaken, during their last attempt at quantitative tightening. So you really understand the mechanics of this in a way that most of us don't. What do we need? So if I'm hearing you correctly, you're saying that just by the mechanics of how this works, everyone takes a haircut, you have to rebalance, and therefore you're going to have to sell equities. From where we are now, what does that look like? What kind of downside risk does that present?
See, that's really hard to measure.
Mm.
So basically, what's going to happen in the coming months is the Fed is going to try to, what they would say is increase the term premium of longer dated treasuries. And what we would say is they're trying to make the treasury rate go higher. And there are good reasons for this, right? So if you look at the housing market, we're going up 20, 30% a year. That's not that's not socially desirable. That makes housing unaffordable, and there's a risk of financial instability there. So the Fed has announced aggressive quantitative tightening, and you can see the mortgage markets over respond. So in the past couple months, primary mortgage rates have gone up 1%, so 3% to 4% now. Um, what the Fed is trying to do is increase the supply of duration into the market. Longer dated treasury rates are largely determined by supply and demand. Fed holds $5.5 trillion in treasuries. It holds $2.5 trillion in mortgage agency MBS. So by trying to get that off its balance sheet, by letting it roll off, potentially selling the agency MBS, you can significantly increase supply of that into the market and push it higher. Now, the Fed hasn't been clear how, or I guess the rate at this will do it, but they've been leaking out or hinting at very aggressive rates. You know, President Bostic suggesting that it could be at least $100 billion a month. The Fed has this lever here where it's trying to increase term premia, and it has the tools to do it by increasing supply. Now, we won't exactly know how much, but it's going to go higher, and that's going to impact people's portfolios, and that's going to lead to rebalancing into the equity market because all markets are connected.
Yeah. So it sounds like there's a huge amount of risk for equity. It's not a sentiment. It's not, you're not making a judgment call just based on the mechanics of how this works. Every road seems to lead back to people having to sell equities. Am I overstating that?
That's how I view this. So the Fed has control over rates. It's telling you it wants rates to go higher. That's just not good for risk assets like equities. If you're a traditional value investor, you would talk about things like dividend discount model or something like that. I don't really believe in stuff like that. I just say mechanically, a whole bunch of people who are holding treasuries and equities are going to have to sell some of their equities to rebalance. And the level of that rebalancing is enormous. People who have these assets, these strategies are in the trillions of dollars. And you have to combine another aspect as well, which is also super important. Market liquidity isn't very good right now. I
Yes.
think what happened is that we have these enormous asset values go up higher because liquidity isn't good, but that reverses as well. An easy way to see this is just what happened to Facebook, say a
Hmm.
few weeks ago. Just $1 trillion stock going down 25%. That's he's just straight up evidence that liquidity is not good. $1 trillion stocks are not supposed to trade like penny stocks.
So when you say there's no liquidity, can we also phrase that it's getting kind of pushed up by this squeeze, by passive investing, by these flows that are going in, but there's no buyers on the downside when something turns. Is that a fair way to describe the liquidity that you're talking about? Like, why is there no liquidity?
I'm not really sure. I think that Mike Green's passive investment theory, which I think you're alluding to, I
Yeah.
think that makes a lot of sense to me. And it seems what happens is that the asset values of these stocks, the prices go up much faster than the actual market depth. So when people are trying to sell,
Mm.
it's like an auditorium. Auditorium gets bigger, the exits don't really get the same. People can't go out at the same time, so prices kind of fall out. And this is not just about the equity market. This is the treasury market as well. So treasuries, cash treasuries, one day is about 600 billion a day in transactions, $23 trillion marketable treasuries. Okay, rewind back 20 years ago, cash treasuries daily transactions about 400 billion, just a little bit smaller than what they are today. But back then, marketable treasuries was like 6 trillion. So it's like, you know, 20, 30% of what they are now. So You have the same thing happening in all our markets. That makes the potential for volatile moves.
So you saw what happened last time. You were right at the in the thick of it. Uh, they thought the repo market broke. We had this massive move. We had markets not working properly, and the Fed had to stop. Do you feel like, because it wasn't so long ago that you worked there, does the Fed broadly, not just the FOMC, feel like they have a better understanding this time around? Or are they once again sort of operating without a playbook, hoping for the best, and then they'll have to react in real time if things start to break?
I think that they think they understand better together, but I don't know if they actually do. And I say this because the tool that they have that is supposed to fix what was broken last time, it's something called a standing repo facility. The standing repo facility is basically the Fed willing to lend almost unlimited amounts of money into the repo market. Now, in theory, this is supposed to prevent anything from breaking during quantitative tightening. But the thing is, that was what was breaking last time. But the dynamics of the financial system are different this time. So that isn't really going to come into play at all. From my
So,
view, what
yeah.
happens during quantitative tightening is that you reduce the cash balances of banks, you reduce the reserves. Now, the biggest impact on markets is what the banks were using that cash for. During the last quantitative tightening, banks were taking their cash, their reserves, so reserves are cash for banks, and investing it into the repo market. When quantitative tightening was happening, they were taking money out of banks, who in turn were reducing their investments in repo markets because they have less cash. So eventually, the repo market hit an air pocket and it blew up. This time around, banks aren't investing in repo at all. It doesn't make sense. Repo rates are too low. What they've been investing their QE cash in are in treasuries and agency MBS to the tune of trillions of dollars. So if anything breaks this time, it's not going to be repo. It's probably somewhere in the rate space.
This is such an important conversation, Joseph, because these are the sort of the I keep going back to the word mechanics, but I think that that's right about what happens when we're in this uncharted territory. And I think what so many people worried about as we stayed here for so long. So I'm going to go back to the issue of, so if something breaks, it's in rates, and because of the maneuvers the Fed has to make, we keep going back to the idea of that people are going to have to sell equities. In both of those situations, is there still a Fed put? Will the Fed, what is the pain threshold that the Fed will get nervous that things are spiraling out of their control? Because a lot of people are saying, listen, the Fed put's dead. They're focused on inflation. They're willing to sacrifice growth. They're willing to sacrifice, uh, you know, pretty big pain in risk assets, in asset markets in order to get control of inflation. You're laying out a scenario that sounds very ominous and problematic, and something that I cannot imagine that the Fed would get behind. So do you think that there will be a backstop if we start to see dislocation in either of those spaces? And do you have any thought about what that would look like?
Yeah, I think that's a really good question because people do commonly think there's a Fed put, and they're right to think that. But I would actually rewind the clock a little bit post GFC, where this whole wealth effect thing began. So post GFC, we had very low growth and very low inflation. The Fed wanted to help the economy out. What do? They try to blow an asset bubble, Bernanke's wealth effect. Why do they do this? The Fed doesn't have power to spend, but it can have a lot of influence over asset prices. So the thinking is if people have more assets, well, higher asset prices, they'll feel wealthier, they'll go out, they'll buy, they'll spend, they'll lend. That will help growth, that will help inflation. Let's say you had some Tesla stock, went up 10 times, you feel richer, maybe you go buy a car, maybe you buy a house. That stimulates the economy. And that's okay because growth is slow, inflation is also low. Rewind to today, what's happening? We have tremendous inflation, asset prices historic highs. Consumers are wealthier than they've ever been. Now, we know the Fed thinks of wealth as a policy tool. It pumped it up to make inflation go higher, and now it can use it in the reverse wealth effect way. Let's say everyone slightly less wealth, slightly less money in an economy, that decreases demand, that helps inflation, which is the biggest problem in the Fed's eyes right now. So I actually think it's, I won't say it's intentional, but it's not an undesirable outcome to have lower asset prices. You can think of it as making housing more affordable.
Mm.
You can think of it as reducing demand, or you can think of it as shrinking the amount of wealth inequality in our
Yeah.
economy, since it's really the wealth is held by a very small percentage of people. Now, I don't know if they're intentionally doing this, but I don't think it's an outcome that they're trying to avoid.
Yeah, that's an excellent point. I was thinking redistribution of wealth while you were saying that. However, I think it's all predicated on the fact that it happens orderly. And that's the wild card, isn't it?
That's
That's
exactly right. There's this
yeah, that's the
once
risk.
it'll feed on itself. So eventually, I agree. There's a Fed put somewhere. I don't think we're anywhere close to it.
Yeah. Then that's going to be something we debate. I want to squeeze a question in, even though we're almost out of time. Tim from the RV site asked, "What are your thoughts on the junk bond market and going short in the rising interest rate environment?"
So junk bonds. I mean, I know they've been selling it off. Part of it is, of course, duration. Rates are going higher. That's going to reprice. I'm skeptical about this talk about credit risk. And the reason being that we're in an inflationary environment, right? Inflationary environment, that means cash flows go higher. That means there's more revenue. Whereas the junk bonds, they were borrowed, in the past, rates are at historic lows. It seems like they'll have no problem paying it off. Now, maybe when they roll it over, that might be troublesome, but that's not the bonds already taken out. So, um, yeah, I wouldn't worry about companies having trouble paying that. If you look at the data, corporate profits are historically high, and inflationary scenario, revenues will continue to increase.
Joseph, this was so much fantastic information for us to think about as we head into what's going to be a really critical couple of weeks. So thank you so much for that. It's so great to hear somebody who sort of understands the inner belly of the Federal Reserve for a change, and helping us understand a little bit better. So thank you so much, and thanks to all of you for watching. Great conversation. I hope you had a lot of takeaways that you can use over the weekend to think as we enter a new week. It's certainly going to be volatile, and we're going to have to be really careful and nimble. If you are a Real Vision viewer, by the way, contact us if you might want to work with us because we are hiring. Just want to mention that as we talk about those tight labor markets. And have a great weekend. We'll see you again next week. Take care and good luck out there.